Hi, everyone, and welcome to this webinar dedicated to Latin America. Today, the speakers will be Reid Janssen from Houston. Well, sorry, just I have the and Homayoun Falakshai from Paris. Alex Booth is also in the conversation and will moderate some questions during the Q&A session. Kevin Wright from Singapore will also intervene for some questions at the end of this webinar. Thanks again for being with us, and I will now hand over to Reid. Reid, the floor is yours.
Thanks, Arthur. Yeah, indeed. We're going to be looking at Latin America today with a focus on just a gradual recovery through Q3 after a difficult Q2. So first we'll break into Brazil. We'll be looking at a number of commodities in Brazil, crude oil, clean products, dry bulks, and LNG. The big takeaway, as I just mentioned, is really Brazil had as is true for most countries globally, had a really terrible Q2, huge contraction in growth that has since given way to a slow and pretty painful recovery through Q3 and beyond, albeit with some caveats, specifically around export flows into the international market. And on that note, we'll first focus on Brazilian crude oil exports. If you look at the chart to the right, it's pretty clear. If you'll notice Q2, Brazil managed to export a record 1.6 million barrels per day. This was largely driven through a record high 1.8 million barrels per day exported through the month of April. Much of this volume was purchased by China, as in the month of April alone, more than 1.4 million barrels per day was exported towards the East Asian state. And this is somewhat counterintuitive when you first think about it, right? In Q2, we were in an oversupply situation. Demand was very weak at that moment in time, but the Chinese were opportunistically buying really cheap spot barrels. And Brazil took advantage of this, shipping a lot of volume towards China. But this narrative has changed into Q3. On average, over the quarter, the state has exported just 1.3 million barrels per day, with September marking a year-to-date low in terms of departures. And you'll notice volumes towards China have really dropped off. And this kind of carries forward the narrative that Chinese purchases have really been key and were very key in driving export volumes through Q2. And this has since led to weakness into Q3. We've also seen an uptick in refinery throughput, specifically domestic refinery throughput within Brazil, specifically, beginning in July. This kind of speaks to the fact that we've seen an improvement in clean product demand within Brazil through Q3. But first, I mean, it's pretty amazing to note the drop-off in clean product imports through Q2. This was mimicked by a lot of weakness in volume from the U.S. Gulf Coast. And volumes have since rebounded back to historically normal levels through Q3 and so far through October. Obviously, the USGC has been key in this recovery. And it's important to note, if the U.S. Gulf has any, in terms of refiners there, have any hope of returning to some kind of pre-COVID normality, Brazilian demand is going to be really key. And so this trade flow is going to be important to watch over the next few months to see if the resurgence in import levels can kind of maintain through the end of the year. Now, some other pieces of data that kind of point to a general improvement in clean product demand apart from import volumes is what I just mentioned. Clearly, refinery throughput, which finished up 5% year over year in July, and this has likely carried forward into August and September. Also, TomTom data has indicated an increase in congestion in Rio de Janeiro and Sao Paulo. Now, it's important to note congestion levels are still some 45% under year earlier levels, but this is an improvement from April and May when congestion levels were 75, 80% under the 2019 average. So in general, we're pretty confident that Brazilian clean product demand looks good for now. But again, there are questions moving forward around whether this can actually maintain for any period of time, especially if the country has to deal with another outbreak of COVID-19. Now, continuing on with a focus around Brazilian refiners, one really solid silver lining for Brazil this year has been LSFO exports. So far on the year, departures have managed 6,600 KT, far surpassing the 2019 total, 4,230 KT. And the reality is that Petrobras made a good bet in setting itself up to produce a lot of low sulfur bunker fuel to meet IMO demand. And this has really played through into even domestic production, crude production levels. In early April, Petrobras initially announced an oil production cut of around 2 million barrels per day, but by the end of the month, they basically reversed this decision, and part of this reversal was likely driven by the fact that LSFO was really strong, especially through Q2 when pretty much demand for all other clean products was really weak during that period of time. So definitely a silver lining, and this trade flow is likely going to continue because vessels are going to need this low sulfur bunker fuel, and Brazil can provide it, especially into Singapore. Now, kind of shifting away from a focus on liquids, obviously Brazilian iron ore volumes are also very important. And the narrative around Brazilian iron ore is pretty straightforward. But before we focus on 2020, you're probably looking at this graph and saying, wow, that was a huge drop off through Q1 and Q2 of 2019. This was driven by the Vale Dam disaster that really tanked exports for several months. But now to skip forward to 2020, the drop off in Q1 really driven by the fact that COVID-19 was spreading through China at that time. Chinese demand was very weak. Obviously, China really drives global demand for iron ore. And Brazilian iron ore departures have since really mimicked the improvement in Chinese demand levels through Q2 and Q3. I mean, through August and September, loadings are really back in line against what we saw through the second half of 2019. Obviously, we're not going to get back to 2018 levels given the dam disaster, but we are pretty much back in line with historical levels relative to 2019. And so this is a positive for sure. Again, there are questions around how long this can continue. Obviously, we kind of have competing narratives between trade tensions between China and Australia could really continue to drive Chinese purchases of Brazilian iron ore. But there are concerns that maybe the Chinese economic recovery could be slowing a little bit and could limit purchases through the fourth quarter and beyond. Those are kind of competing narratives at this moment. There's also been really strong price action for iron ore. Prices are up about 35% year to date, holding over $120 per ton. And this has really been driven by strong Chinese demand and the expectation of Brazilian disruption. We really haven't seen Brazilian export disruptions. So when you're thinking about iron ore prices, you really need to be thinking of it in the context of, is this justified by the Chinese demand picture, not really by whether Brazilian exports are being disrupted, because we really haven't seen those disruptions percolate to the surface this year. One final narrative to kind of take a look at when it comes to Brazil is power. LNG and thermal coal imports have pretty clearly weakened a lot through Q2 and Q3. I mean, if you look at the graph to the right, we're definitely towards the lower end of a range going back to 2017. And the reason for this is twofold. So if you look at the graph at the bottom, I've listed the year-over-year change in hydropower output and thermal power output. Usually, these two sources of power offset one another. If you have a strong hydropower output, thermal power output tends to weaken on a year-over-year basis, and vice versa. This was not true through Q2, and this is very rare. So if you'll notice, both hydropower and thermal were either flat or lower through Q2, which is not a characteristic you often see. And this is really indicative of the fact that just overall power demand in Brazil was weak due to limited economic output. But this has since reversed into Q3, and we've moved back into a more normal situation of inverse. And in this case, we've seen hydropower really gain year over year and thermal power really decline year over year. And so through Q3, this has really driven the weakness in thermal and LNG import volumes. Whereas in Q2, it was just due to overall economic weakness. Q3, it's really more a result of strong hydropower production output and a weakness in thermal power production output. And so with that, I'm going to hand over to Humayun, and he's going to cover in rapid succession several other LATAM countries. Humayun.
Great. Sorry, do you want to continue with Colombia first, and then I'll take over with Mexico and Venezuela?
Absolutely. Yeah, for sure. So yes, continuing forward with Colombia. Yeah, my mistake there. We're just two quick slides on Colombia. First, thermal coal, very important for Colombia in general. And this year has been not good. So you'll notice the graph to the right shows the 21-day moving sum of thermal coal exports by year. And you can see a pretty clear delineation between 2018, 2019 levels and 2020 levels. And we've seen volume departures weaken even further into September and October. And the reasons for this are really due to the fact that the market for thermal coal is very weak, and there have been a number of mine closures as a result of this weakness, which is helping to weigh on volumes. The CNR mine has been closed. Prodeco has been closed. Cerejon has been closed. These mines were initially closed due to COVID-19 concerns, but that has since moved to the fact that just spot prices are really not making it viable for these mines to remain open. There is, in terms of the possibility of any kind of resurgence in volumes through the end of the year is going to require a improvement in demand within Chile and Brazil. Also, Turkish demand for Colombian coal, which has actually been pretty strong on the year, is going to need to remain in place for any hope for Colombian coal exports to pick up through the end of the year. But For right now, our view is that the outlook for Colombian thermal volumes is not good, and domestic producers are clearly feeling, are clearly moving towards basically just cutting back volumes significantly as a result. Second, just a quick coverage on Colombian seaborne oil exports. You'll notice that departures have really moved out of that pretty tightly bounded range that's normal for Colombian exports. Obviously, they don't export a ton of crude, but volumes have really, through September, dropped to the lowest point we've seen since at least 2017. And you'll notice that pretty much since April, departures are down year over year. Any recovery is really going to be driven by U.S. purchases. Colombia, unsurprisingly relies heavily on U.S. purchases given the proximity of the two countries. Some alternatives could include volumes towards Asia and maybe an uptick in volumes towards China. But again, that's really in question at this point. It's likely that departures are going to remain at pretty weak levels through the end of the year. And of course, it's all relative, right? Usually volumes sit around 600 KBD, and we're looking at maybe 100 to 150 KBD cut in exports through the end of the year. And so now with that, I will hand off to Humayun to cover some other countries and LATAM. Humayun.
Yeah, no worries, Reid. So thanks, and hello, everyone. So indeed, I'll be looking at recent trends, Mexico and Venezuela, with a focus on oil. Later on, we'll touch a bit on wider LNG in the region. So starting with Mexico, if you can see the slide, yes. So the chart here on this slide shows you the country's seaborne oil exports by destination country. So as you can see, oil exports have actually remained quite stable. If you compare this with other OPEC Plus countries, for example, this downward, so it's still a downward trajectory for Mexico since the first quarter of this year, but it's been quite a slow downward trajectory. So in September, exports reached 1,060,000 barrels per day. So this is down from the highs of the year, which were at 1.2 million barrels per day in April. But still, it's still in line against year earlier levels. So overall, in 2020, we're even higher, 25,000 barrels per day compared to 2019. Now, as you can see on the chart, the main oil customer for Mexico is the U.S. by far. So that's the green columns. And this actually has played out well for Pemex, which has been able to take advantage of spare storage capacity in the U.S. Gulf Coast. So despite U.S. demand being down, a lot of refiners on the Gulf Coast have managed to import a lot of oil mainly from Mexico to fill their storage capacity. However, export to other customers, such as, for example, India, have fallen, and this is due, obviously, to lockdown measures there, but also to the lack of sufficient storage capacity in those other countries, as, for example, India or Southern European countries. Now, this stability in oil exports is also due to internal politics in the country. So Pemex, the national company, is very important to the president's priorities, so Andrés Manuel López Obrador, AMLO. And that actually explains the country's very tough position within OPEC Plus back in April when OPEC Plus managed to reach their historic deal. So at this meeting, the country managed to only pledge a 100,000 barrels per day cut, when the consensus indicated that it should actually have cut production by 400,000 barrels per day. Another consequence of this, so going a bit out of the oil sector, of the oil production side of things, is the extreme high number of COVID cases recorded at the company, at Pemex. So more employees have died at Pemex than at any other company in the world. So a sad record for the country. Now, in the long run, coming back to our production and exports, so the future is not that bright for Pemex and for the country. The 2013 energy reform had managed to attract a lot of players within the industry, actually the whole industry, with majors, national companies, independents, all wanting in. But the current government may fully repeal that energy reform, and that opened the way for IOC. So in terms of production, July, we were at 1.6 million barrels per day, and that was the lowest in 40 years. And while new discoveries such as, for example, Zama or Sasken could add another 150 up to 300,000 barrels per day to production capacity, delays are very likely under the current government. So delays are very likely to hit the original timeline. So, for example, Zama was discovered 3 years ago and is still yet to take FID. Now, a bit of a certainty, though, on exports in the long run is linked to the new refinery that the company is building, the Dos Bocas refinery. So we'll have a 348,000 barrels per day capacity, and this will mean that both oil exports would decline, but also clean products imports, because obviously that refinery would be used to produce clean products as well. So that takes me to the next slide, where we take a closer look at the clean products situation in the country. So again, looking at Mexico, it's a very singular one because Pemex typically imports about the 2/3 of the country's gasoline needs. And the refinery I mentioned is getting built despite Pemex's refining business being losing money for a very long time. Now, anyway, getting back to the current situation, it's no surprise again that we've seen CPP imports fall massively in 2020. So you can see these clean products imports with the blue line here, referring to the left axis on the chart. So in Q2, imports were down about 43% year on year. So that's a fall of more than 300,000 barrels per day. In Q3, as you can see, we saw imports going up, even though they fell again in September compared to August. Now, at the same time, refinery throughput in the country in Q3 this year has been around 20% lower compared to last year. So this is the columns, the columns in color that you can see on the chart, and they refer to the right axis. So there are multiple reasons behind this, including some technical issues such as power outages at the Salina Cruz refinery in August, which led to shutdowns. But there's also maintenance, like normal maintenance, that has been taking place in Q3, and that explains that lower throughput at these refineries. Now, there's two possible consequences for this. The fall in throughput may have shifted crude supply to international markets, hence the high export volumes that we saw in the previous chart. And secondly, it may also soften the view that demand is picking up as clean petroleum products imports have increased. Now, nonetheless, we looked at TomTom data, so looking at road traffic, and that indicated that congestion levels in Mexico City are about 50% below the 2019 average, and this is while back in May it was about 82% lower. So in terms of road traffic and gasoline demand, it most probably has gone up though. Now, another point about Mexico's CPP imports is the strong link that exists with U.S. Gulf Coast refiners. So players such as Phillips 66, Valero, Marathon are currently struggling, not only due to U.S. demand, but also due to Latin America not buying much, and that includes Mexico. The Gulf Coast refiners heavily lean on Mexican demand for their clean products. And in terms of clean products imports into Mexico, it's about 80% of these that come from the Gulf Coast. So a very chunky amount. We're talking about last month around 430,000 barrels per day. So therefore, Mexican demand is very important, very essential for U.S. Gulf Coast refinery runs and throughput. And finally, another point on Mexico is that the Dos Bocas refinery means that there will be lots of pressure in the coming years when it will be when it will get on stream. That is supposed to take place in 2023. That will put a lot of pressure on European refiners because, again, the U.S. Gulf Coast has now become an export center. So what's likely to happen is that these clean products out of the Gulf Coast will head towards Asia, but also towards Europe when that Mexican refinery gets on stream. Now moving towards Venezuela, the next slide. I guess it's a surprise to no one really, but the country has been having oil production and export issues for years now. This was obviously intensified by U.S. sanctions that were put in place back in January 2019. But they also got even worse with COVID-19 this year. So that trend accelerated actually when Chevron and other U.S. service companies were denied a new sanctions waiver to continue to operate in the country. So in Q3, secondary sources have put the country's oil production at only 360,000 barrels per day. But we actually saw exports averaging 380,000 barrels per day on that same quarter. So good news on the Venezuelan oil sector are rare these days, but we've actually seen exports bottom out and rebound for the fourth month in a row now. In September, we've seen exports reach 500,000 barrels per day. We actually saw inventories fall as well, but only by 1.5 million barrels in September, indicating a draw of about 50,000 barrels per day out of storage again in September. So our view is that production is certainly higher than that 360,000 barrels per day. Now, as you can see, most new exports in Q3 have been going to India. So this is the orange columns that you can see on the chart. And more precisely, they've been going to the Jamnagar refinery, which is owned and operated by Reliance Industries. There's a reason behind this. Reliance has signed a swap agreement with PDVSA, the national oil company of Venezuela, that allows them to take crude in exchange for diesel supply. Now, this is compatible with current sanctions, current U.S. sanctions, as Washington exempts some Venezuelan oil trade if the transactions are in exchange of fuel or food, for example, if they don't involve cash, which is not the case here. So that means that India, once again, is the main recipient of Venezuela's oil. But the question here is for how long? Actually, the threat of sanctions has pushed Reliance to secure 12 million barrels of Canadian heavy oil as a replacement to Venezuelan oil. So we're yet to see if this will continue for a longer run. And while this is made possible for India, the fact that they're able to secure oil and trade it for fuel, it's obviously much trickier for the Venezuela and Iran trade. And that brings me to the next slide. Basically, looking at these trades, let's say that it's not accepted with the same manner by Washington. So on this slide, we're looking at the clean petroleum products imports into Venezuela. So obviously, U.S. sanctions have hit the country's ability to import much-needed diluents for its oil production operations. The produced oil at the Orinoco oil belt in center of Venezuela is so heavy that it needs that PDVSA needs upgraders to improve crude quality. These upgraders require diluents such as condensate or naphtha. Now, as you can see on the chart, these used, so before U.S. sanctions were imposed in January 2019, these used to mostly come from the U.S., but also from places such as Nigeria or Algeria. But the lack of these products has hit crude production and refining, as we saw on the previous slide. So this has led the country to the blink of fuel shortages, and it went through actually from having the world's cheapest gasoline at only 2 cents a liter to having the world's most expensive gasoline, because gasoline now on the black market trades at around $4 per liter in the country. And you sometimes need to queue up for 3 days in order to access gasoline. Now, coming back to that Venezuela and Iran trade that I was speaking about. So Iran has been helping Venezuela recently with shipments of gasoline. We saw multiple shipments take place in May. So on the chart, you can see Iran in green. That was the bottom right. So the most recent trade, the most recent cargo carrying Iranian gasoline arrived on the 29th of September in Venezuela. There's been other trades that have been including oil for fuel. So I mentioned India earlier, but also Southern Europe, and that's why you still see imports from Southern Europe. And these most likely are part of debt repayment deals. Now, while Iran has been sending gasoline in the past few months, we think that this bilateral trade may have stepped up because we've recently seen 2 million barrels of Iranian condensate this time, so not gasoline, but condensate, reach the port of Jose in September. Now, that condensate is very likely going to be used as a diluent for Venezuelan production operations. And what's even more interesting is that it looks like that same vessel then loaded Meray crude and has since departed the Venezuelan coast. So, I mean, to be honest, God knows what it's going to do, but it could be a way from Venezuela to pay Iran for gasoline, for its gasoline and condensate. Now, moving on to the next slide, before we end the presentation, I'm just taking a quick look at recent LNG trends in the region. So Reed spoke earlier about Brazil already, but here we're going to take a look at Trinidad and Tobago, so the Atlantic LNG plant. So this is a quite chunky installation. We're talking about a 15 million tons per annum LNG facility, and that's, it's an installation that is quite important to companies like Shell and BP. So exports have been relatively stable over the past years. They've been holding at between 12.5 and 13 million tons in each 2018 and 19. Now, in 2020, obviously, the coronavirus impact, the story has been a bit different. Now, what is interesting is the destination of this LNG and where we have seen the biggest impact. So the biggest impact that we've seen is in shipments towards Europe. So these used to be at around 700,000 tons per month, and they've since fallen to around 200 to 250,000 tons, so since the month of July. And this is while exports to Asia and the Americas have been relatively stable. And we also saw over the past few weeks a few cargoes stay in floating storage. So a few cargoes taking LNG out of Atlantic LNG and stay in floating storage for a few weeks before finding a home for their LNG. And I'm going next to the last slide. So on the demand side, so going from the supply to the demand side here, Latin America's LNG imports show how much gas demand has been impacted this year, but also that it's not really a new trend. So the graph here shows you the quarterly LNG imports by destination, but we're showing the delta year on year. And Latin America here is shown in gray, and you can see that trend is not something new. So we had seen Latin America's LNG imports on a year-on-year basis start declining for most of the past quarters, actually. In 2020, LNG imports into the continent reached 4.2 million tons so far, and that's a fall of about a third compared to 2019. And when comparing this with Asia and Europe, you can see that the continent's LNG imports have been impacted way much compared to Europe and Asia. So in Europe, for example, we're down only 11% year on year. In Asia, we're even higher year on year because thanks to a very strong first quarter, as you can see here. So in Asia, we're actually up 2% year on year in terms of LNG imports. Drivers for these low imports in Latin America have mostly been lockdown measures in Brazil and Mexico. So these two countries take the biggest share in the decrease in LNG imports. But the other driver also has been the fact that we've seen higher hydropower output in Q3, therefore reducing the need for LNG. And that's everything from me. So if you want to wrap up.
Absolutely, yeah, thanks. Just before questions, just a quick wrap up of summary. Again, we want to reiterate that within LATAM, the demand recovery is slow. It's slow coming. right? The import of clean products has generally shown improvement through Brazil and into Mexico. On the export side of the equation, there's a lot more questions to be answered, specifically around Colombian thermal coal and Brazilian oil exports. And so for now, we are really showing a mixed picture, right? A slow and pretty painful recovery through a lot of these economies, and a very mixed to negative export market. With obviously the exception of Venezuela, which is just a mess on all sides. And so with that, I'll hand it over to Alex B., who will moderate our questions.
Thanks, Reed. So I think the first one we will pose to Kevin, and it follows on from the developments that have been coming out in the dry bulk market, and specifically around the coal market over the course of the last few days, relating to the trade between China and Australia, or more accurately, Australia and China. And we put an update out on this yesterday, in fact, focusing on the kind of real dependence on Australia that China has for met coal imports, basically. But this relates more specifically to BHP. So, Kevin, do you see BHP changing strategy more quickly than expected and divesting coal assets, as Rio Tinto did in recent years?
It's a really interesting symbiosis stroke dichotomy between BHP and Rio Tinto and China. Obviously, China needs the iron ore, and we've seen very little impact in terms of iron ore imports from Australia into the Chinese foundries and smelters in recent years and recent months, despite the fallout between Canberra and Beijing. At the same time, however, the Chinese government seems to be keen to invite alternative sources of coal for power generation and also for steel production. Now, the interesting thing about this whole question is BHP produces around 70 million tons a year of metallurgical coal and about 17 or 18, i.e. 17 or 18 million tons of thermal coal. So if the Chinese were suddenly to turn around and say they don't want the metallurgical coal from BHP, then that has an impact, obviously, on BHP's output. And I think that would drive BHP to look very closely at strategy. The thermal coal side of BHP, and I spent a little bit of time before working with Kpler on the BHP sort of energy spectrum, if you like, or energy makeup. And coal is something on the thermal side that BHP are looking to get out of. But 17 million tons versus 70 million tons is a different kettle of fish and different scale altogether. So if the Chinese were to suddenly turn around and say, we don't want BHP's metallurgical coal, that has a significant impact on BHP. And I think they would obviously have to look at their strategy around metallurgical coal quite clearly.
Cool. So next question is related to the Gulf Coast. So in Gulf Coast refining margins, obviously we were talking about how dependent the Gulf Coast, or not dependent, but there is a significant boost to Gulf Coast margins and Gulf Coast operations from exports to Latin America. So the question is kind of how are refining margins in the Gulf Coast at the moment? And if demand continues as it has today, then what's the potential solution? Kind of what could be the solution for Gulf Coast refineries going forward? And I think, Reed, that's one for you.
Yeah, not an easy situation for USGC refiners. The problem is that obviously you still have huge weakness, and just to answer your question, margins are not good anywhere globally, especially not along the Gulf Coast. And I mean, this is primarily driven by the fact that you have really pretty weak. We've had pretty weak demand within the United States for some time. Latin America is a piece of this equation, but we've started to see a resurgence in demand out of LATAM. This doesn't take away from the fact that you're still going to need to see demand come back within America. And so until that point happens, really what we're saying is, okay, part of this demand piece is starting to show improvement. That is LATAM demand. but this still leaves big questions when it comes to the much bigger piece, which is U.S. demand for domestically produced clean products, which, until that comes back, we're going to see margins really struggle, I think, along the Gulf Coast.
Excellent. Thanks, Reed. So probably the last question that we can look at, just in terms of time, is related to crude oil and kind of Latin American crude oil exports to Asia. And the question is kind of which countries export to Asia, and then around what kind of grades are they, predominantly medium heavy crudes. And I think that can probably go into Omayun. I would also add kind of a question there that is saying, how do we think we could see a kind of any rebound or potential rebound in a pickup in Latin American crude exports? It's like what do we think would it take to see exports pick up going forwards through Q4?
Yeah, sure. So looking at Latin America's exports towards Asia, so it's most countries out of Latin America export somehow towards Asia. So we're talking about, for example, Brazil, Venezuela, Mexico for the main ones, but also the smaller ones like Colombia, Ecuador, Argentina, and so on and so on. In terms of the crude, of the grades of the crude that are exported, it's mostly yes. So the answer to the question is yes. It's mostly heavy crude and very heavy. So about half of the crude exported, and in terms of volumes, we're talking about between 2.1 and 2.4 million barrels per day on average over the past 2-3 years. That have been exported from the continent to Asia. And so, yes, about half of this, a bit more than half even, is very heavy crude. So we're talking about grades such as, for example, Merey out of Venezuela, such as Maya in Mexico, Lula or Iracema out of Brazil. So most of these exports are heavy grades and very heavy, between 17 and 22 API, and the rest being medium crudes around 30 API. So grades like, for example, Sapinoa or Napo.
Brilliant, thanks. So I think that is everything. Thank you for joining us today on our Latin American focused webinar, and we look forward to you joining us in our next webinars. Thank you very much.